Let's talk some more bonds. Larry Shover is joining us, the Chief Investment Officer at Efficient Advisors. Larry, this has been a pretty interesting move today as equities have come back. Bonds keep selling off, and they were selling off when equities were down, too. So it seems the Treasuries, as we said earlier on the show here with our first guest, have kind of been on a mission today. What do you make of it?
Yeah, it does seem like they're on a mission today. When you look at 10-year yields up, 7 basis points today to 71. But we have to maybe keep it in mind that they're still within that prevailing range that we've seen of 60 being the low, 78.7 being the high. And, the numbers today didn't really alter the narrative. I just think that it was supportive, and therefore people are more interested or, fairly interested in selling treasuries and buying stocks again after that sell-off. But also you have a lot of debt supply coming on the market next week, and that, more often than not tends to put a little bit of an artificial inflation into the yield.
So, Larry, what do we generally kind of think is the blueprint for bonds going forward right now? Because it seems the Fed is stepping off the pedal. They're going to let inflation run a little bit, and they're not terribly keen for yield curve control, negative rates either. So for the bond market, does that imply a kind of gradual climb in yield, or does it depend on the economic data? Does it depend on the stock market action? What drives bonds if the Fed doesn't do anything different? If they actually stand by it this time, right? We did that once before in 2018, and then it didn't really last very long.
Yeah, no, it's great questions. And I do think, there is 2 weeks before the Fed meeting, but let's face it, I think the Fed would act if the stock market was down this time next week, 30% from where it is today. I think they would act, and I think the bond market knows that and is saying that. But by and large, the last 2 or 3 episodes where the 10-year yield got above 75 basis points, you saw a lot of buying to force that yield back down. And so I think in the back of everyone's mind, or at least consensus, is that, there could be a slow drift up, but maybe not so quick, because there's so many unknowns in the market, and we all know that. And I think we get jaded just because the stock market continues to climb, but we realize that there's still a lot of people without work. There's a lot of hope on a vaccine. There's consumer angst, and so also inflation expectations, whatever you want to make of that. So all that to say, I think we're in a really tight range, and will be until further notice.
Okay. So if we look at this economy as being affirmed by this morning's report, as you put it, continuing to gradually improve, what do we use then for bonds to think about levels? You mentioned the range that we've largely been in, 6.2 to 7.4 basically for the last month. Yeah. Where do we think if we start to break above that? Where do we put the goalposts on a chart that for bonds is just hard to figure out? It just had this massive dive in yield, and then after the craziness of whipsaw in March, went nowhere. At the end of the day, we could just say that the 10-year yield hasn't moved in 7 months.
That is true. Yeah. And so with that in mind, I think it's abundantly obvious that 1% would be the psychologically important number, but or yield to get to. And that could easily happen, not overnight. I think it's going to be a slow drift with a lot of put and takes, with a lot of things like I mentioned before. Right now, it seems to have a lot of problems getting above 75 basis points. But that said, we're going to have 3 steps up, 2 steps back, that sort of thing. If inflation data comes in like it's supposed to, and we'll have a CPI core inflation read this time next week, that will help. If more of the consumption data points towards higher yields, and obviously if the stock market continues to behave. But getting above 1% without a material shift, it's going to be a hard thing to happen. It's going to be a hard thing to happen.
Okay, Larry, in terms of what it means for an overall trading strategy or portfolio, should bonds then be considered not this kind of like rock that it always has been, the same percentage allocation? Do you have to account for potentially bigger swings and maybe the capital gains of the last 10, 20, call it 30 years? Are those going to be harder to come by as well?
Yeah, there's so many different philosophies on that, and I continue to view the fixed income market in your portfolio not as a profit center, but as a stabilizer. And so if you view it as a stabilizer, fully realizing that it's not going to provide you with the same benefit now with 10-year yields at 70 basis points as they would if yields were at 3.25. However, it's still a stabilizer. And so I wouldn't be tempted to decrease or increase my exposure to bonds based on what I think is true, because that's typically wrong. And just use it over the last 25, 30 years as a stabilizer to the portfolio and continue to keep diversified.
Larry, great to have you here. Good to catch up. Have a great long weekend, sir.
Thank you.
Thanks a lot. Great thoughts on the fixed income market. Larry Shover is the CIO at Efficient Advisors.